Hi everyone, welcome back to Positioned.app. Before we begin, if you enjoy practical swing trading education and market analysis, be sure to follow, subscribe, and join us for free at Positioned.app for more educational trading content and swing trading strategies. Today we're going to break down one of the most popular and powerful concepts in technical analysis, the breakout trading strategy. By the end of this video, you'll understand what a breakout is, why it matters, how to identify high probability setups, and how to manage risk with discipline. Let's get started. At its core, a breakout occurs when price moves beyond a defined support or resistance level, accompanied by expanding volume, and continues in that direction. The key is confirmation. Price must close decisively beyond the level. A brief intraday breach is not sufficient. Commitment is validated at the close. Price action often behaves like a coiled spring. During consolidation, markets move sideways as buyers and sellers reach temporary equilibrium, quietly building pressure. When a catalyst, such as earnings, macro data, or shifting demand, emerges, price breaks decisively through resistance. That move is the breakout. Breakout strategies operate at the intersection of technical structure and market psychology. Resistance and support represent areas of price memory, zones where supply or demand previously dominated. Resistance marks a level where supply once overwhelmed demand, while support reflects the opposite dynamic, where demand previously absorbed supply. When price decisively breaks above resistance or below support, prior participants are forced to adjust, often accelerating momentum in the direction of the move. There are two primary forms. First, a bullish breakout occurs when price clears resistance and continues higher. Second, a bearish breakdown occurs when price falls below support and continues lower. Structurally, they are mirror images. Today we'll focus primarily on bullish breakouts, but the principles apply symmetrically. Not all breakouts carry the same quality. A thin volume spike is very different from a structured expansion supported by participation. Before we dive deeper, let's see how traders can analyze breakout setups directly inside Positioned.app. Open the dashboard and launch the full-screen chart for any stock on your watch list. The expanded chart view gives you a distraction-free environment to study key resistance levels, volume behavior, and consolidation patterns with precision. You can quickly switch between time frames, apply technical indicators like RSI, MACD, or Bollinger Bands, and zoom in on breakout zones to evaluate entries and risk in real time. High-probability breakouts are built on structure. Let's walk through the 5 pillars. First, identify a meaningful level. Significance comes from repetition. When price tests the same zone multiple times without breaking, that level gains credibility. Each test reinforces market memory, orders cluster there, and liquidity builds. Confluence strengthens the case further. Round numbers, prior highs, heavy volume nodes, or multi-month resistance all increase the probability that the level matters. Second, consolidation precedes expansion. Before most valid breakouts, price tightens into a recognizable structure. Common patterns include rectangles, ascending triangles, flags or pennants, and the cup and handle formation. Each reflects the same underlying narrative. Supply is gradually absorbed, and pressure builds beneath resistance. Third, volume confirms intent. Many traders overlook this. During consolidation, volume typically contracts. The market is compressing. At the breakout, participation must expand. A decisive surge in volume signals commitment from larger participants. Breakouts on weak or below average volume lack conviction and are prone to failure. As a practical guideline, breakout volume should exceed recent average volume meaningfully, ideally 1.5 to 2 times the 20-day average. Fourth, time frame determines weight. A breakout on a weekly chart reflects sustained positioning over months and carries greater institutional relevance than an intraday move. Institutional capital operates primarily on daily and weekly horizons. Aligning with higher time frame structure improves probability through what technicians call time frame alignment. Finally, context governs probability. Is the broader market trending higher? Is the stock outperforming its sector? Breakouts aligned with prevailing trend conditions, particularly in leading stocks within strong sectors, have structural tailwinds, a principle emphasized in the Chartered Market Technician (CMT) Association curriculum. Trading against the dominant trend reduces statistical edge. As you evaluate these breakout pillars, the full-screen chart makes multi-timeframe analysis far more efficient. You can move from daily to weekly charts in seconds, compare volume expansion during breakout attempts, and customize over 140 technical indicators to match your strategy. The integrated watch list also lets you rotate through multiple breakout candidates quickly, similar to how professional traders scan for setups during market hours. A practical way to stay disciplined is to use a pre-trade checklist. Before entering any trade, evaluate key factors such as market structure, the quality of consolidation, volume confirmation, time frame alignment, and overall market conditions. Many traders assign a score to each category and require a minimum threshold before taking action. This process-driven approach helps reduce emotional decisions and replaces impulse with consistency and discipline. Identifying a breakout is only half the process. Execution determines profitability. Trade management rests on three components: entry, target, and risk control. For entry strategy, there are three primary approaches. First, aggressive entry initiates a position as price trades above resistance. It offers better pricing but carries higher risk of a false breakout. Second, conservative entry waits for a decisive close above resistance, entering on the following session. This approach sacrifices some early movement, but materially reduces the probability of a failed breakout. For developing traders, confirmation should precede capital commitment. Lastly, a more advanced method is the retest entry. After breaking out, price often revisits former resistance, now acting as support. This role reversal provides a structurally favorable entry with improved risk-reward alignment. For example, inside Positioned.app's full-screen chart, traders can zoom into the breakout candle, monitor whether price retests former resistance as support, and use crosshair tools to calculate precise entry and stop-loss levels. This helps transform chart analysis into a structured execution plan rather than an emotional decision. For price target, the most common projection method is the measured move. Calculate the height of the consolidation range and project that distance from the breakout point. The pattern's depth becomes the initial objective. Some traders supplement this with Fibonacci extensions, particularly the 1.272 and 1.618 levels, as secondary targets. These tools refine projections, but do not replace structural logic. Lastly, stop-loss placement. Professional trading is not just about finding setups, it's about managing risk consistently. Inside the full-screen chart, traders can measure breakout ranges, estimate reward-to-risk ratios, and monitor volume confirmation before entering positions. The ability to quickly switch between intraday and higher timeframes also helps validate whether the breakout aligns with the broader trend. Risk management is non-negotiable. The stop-loss defines invalidation, the point at which the breakout thesis is proven wrong. Standard placement is below the breakout candle's low for aggressive entries, or below former resistance, now support, for conservative entries. If price falls back beneath that level, the breakout has failed. Position sizing must be derived from risk, never the reverse. If the distance from entry to stop is $2 and the maximum acceptable loss is $200, the position size is 100 shares. Risk determines exposure. Professional practice typically requires a minimum 2-to-1 reward-to-risk ratio. If the stop is $2 and the projected target is $10, the ratio is 5-to-1, structurally attractive. If the target is only $3, the ratio falls below acceptable threshold. Discipline requires passing on suboptimal setups. Every breakout trader must understand the primary risk, the false breakout, also known as a fakeout or head fake. It is one of the most costly errors in technical trading. Understanding its mechanics preserves capital. They occur for three primary reasons. First, liquidity dynamics. Stop-loss orders often cluster just above resistance. When price briefly pushes through that level, those stops are triggered, creating temporary momentum. Once that liquidity is absorbed, price can reverse sharply. Second, insufficient participation. A breakout without expanding volume lacks conviction. Without broader market commitment, the move is structurally fragile. Third, macro interference. Even technically, sound setups can fail when unexpected news shifts risk sentiment. Central bank decisions, economic data, or geopolitical developments can overwhelm chart structure. Mitigating false breakouts requires discipline and structure. First, insist on a decisive close beyond resistance, not merely an intraday breach. Second, confirm above-average volume on the breakout. Third, avoid initiating positions immediately ahead of major macro catalysts that can distort price action. Fourth, define your stop-loss in advance and execute it without hesitation. And finally, consider waiting for a pullback and retest the breakout level before committing capital. A disciplined process reduces emotional decision-making and protects long-term capital. Let's zoom out to portfolio-level risk. Professional frameworks typically limit risk to 1-2% of total capital per trade. For a $50,000 account, maximum exposure per trade is $500 to $1,000. This constraint may appear conservative, but it protects against inevitable losing streaks. Losses compound faster than gains recover. A 50% drawdown requires a 100% gain to break even. Longevity in markets depends on protecting downside first. Preservation precedes growth. Behavioral research shows losses are felt more intensely than gains. Systematic stop-loss and target rules counteract this bias. Let's briefly recap. A breakout is structured expansion beyond a key level, supported by participation and aligned with market context. High probability setups require a meaningful level, consolidation before expansion, volume confirmation, time frame alignment, and trend context. Execution requires discipline, defined entry, measured targets, logical stops, and strict risk control. In the next video, we'll apply this framework to a real-world chart and walk through the breakout step by step, from identification to execution. And this is where Positioned.app helps bring the entire breakout process together. From your dashboard, you can monitor portfolio stocks, identify active trading signals, and instantly move into the full-screen chart for deeper technical analysis. Whether you're tracking consolidation patterns, volume confirmation, or breakout retests, the platform is designed to help traders analyze markets with structure, speed, and clarity. If you found this helpful, like and subscribe for more trading education content. Also sign up for Positioned.app for real-time swing trading signals. Let's make smart trading decisions together. Thank you for watching. Until next time, happy trading.